Hello, my name is Joe Bell, and today we're going to discuss credit spreads and iron condors. A little bit about myself. I'm a senior market analyst for Schaeffer's Investment Research, and you see that acronym CMT. I am also a chartered market technician. At Schaeffer's, we focus a lot on sentiment, technical analysis, fundamental analysis, but we also zero in and focus a lot on option strategies and applying different option strategies for different outlooks and market environments. Today I want to talk about two of those strategies, credit spreads and iron condors. I think these are great strategies for different price environments, especially ones where you don't get that big directional move, some of those trading range behaviors, and these are two strategies I want to talk to you a little bit about today. First, I have a price chart of the Russell 2000 since July 2009. Now, it's a simple price chart, but I think it speaks volumes. I have these identified here. Different points. We have uptrends with pullbacks, trading ranges, a steady uptrend here, times where it goes sideways. We have choppy price action, sharp pullbacks. Sometimes they're volatile. Sometimes you have slow, steady bleeds sideways. The question is, what tools or what investments are going to be good during these different price environments? Today I'm going to talk about some of these that might be good during some of these trading ranges or the times when perhaps we've had a strong run up and there's a little bit of sideways price action before those sharp declines. These tools, these credit spreads and condors, can be good tools to have to profit during these time periods instead of just perhaps sitting on the sidelines. Now, the first strategy I want to talk about, the basics of the bullish credit spread. So with credit spreads, you can structure them bullishly or bearishly. With the bullish scenario, you're going to sell an out-of-the-money put, and you're going to buy a further out-of-the-money put. So in this case, it was the April 75 put, and you were purchasing the 73 put. Now, in this scenario, as long as the security is staying above that 75 strike, we're good to go, and we're going to keep that premium that we collected. So the question is, we're using puts, especially people new to options. The put seems like a bearish scenario. Why is this bullish? Because we're selling puts, and our desired result is that both puts expire worthless, and we keep that premium that we took in when we initiated this trade. And we'll go over an example here in a minute, which could sort of help you understand the dynamics of that. Like I mentioned before, the bearish credit spread, it's going to be the complete opposite. We're going to sell an out-of-the-money call, in this case the April 85, and we're going to buy a further out-of-the-money call for a net credit to your account. So whatever you sell that 85 call, the 86 call that you're purchasing is going to cost less because it's further out of the money. The difference between those is going to be that credit you're going to keep. As long as that stock or security stays below that sold call, you're going to keep that credit. And again, why is this bearish? It's bearish because your desired result is that both calls expire worthless and that security stay below that sold strike. Now, why do I like credit spreads? What's the purpose? What attracts me to these? I think there's a few different things. You have higher win rate, which means compounding your gains. As I talked about briefly before, you can profit from moves and also profit from the lack of moves. During those sideways consolidation periods, which a lot of people don't get anything done, time decay is now on your side. So time decay is not something you're working against. It's in your favor. One other thing I do like is the risk is defined by your margin required for the trade. So when you do a credit spread, you know going in what is the most money I can lose. And from a risk standpoint, I think that's very important and a great feature. And finally, you can profit when option premiums are expensive. We have all different types of market environments. Sometimes premiums are really expensive for options and you just can't get anything done on the directional side. These tools can help you profit at those times when the option premiums perhaps are very expensive. So how do we pick direction at Schaeffer's? Obviously, you can use these tools in your own trading, whatever sort of technical indicators or sort of sentiment or fundamental, whatever you like to look at, you can still look at and use these tools. I just want to touch base on some of the things we look at real quick. Strong price action with negative sentiment and weak price action with positive sentiment. Really simply, we find that stocks that have counter trend sentiment, very powerful for those trends to continue. Technical support and resistance levels. We use technical analysis quite a bit, includes overbought, oversold indicators. I touched briefly on implied volatility. Large spikes in implied volatility, perhaps good times to sell premium for the credit spread or the Condor. And option open interest configuration. I could probably do a whole presentation on this on its own, but the interesting dynamics of the call and put open interest and sort of the resistance and support areas that they can create in the short term, an interesting dynamic. And finally, short interest, just those going out and betting against the shares from a contrarian point of view. Sometimes you get those, the old short covering rally that you hear a lot about. That can be very powerful in trading as well. All right, now moving gears, I want to get back into a credit spread trade to give you a little bit better look at the dynamics of how these are entered and created. This would be selling the December 80, which is the out-of-the-money strike put, and purchasing the further out-of-the-money December 79 strike put. Now, at this time, you collected about 12 cents, and we're going to go over the dynamics of the return on margin here in a moment, but just to go over some of the technical basis here for the trade. At this point, we had the 82 area was a site of former congestion here, which we thought was support. And 81 area was another important former support and resistance area going back into time. So we had multiple layers of support there we thought would hold. And also, IWM broke above a descending trend line right during this day here. So that was a very bullish scenario as well. And then finally, just something we looked at, big pickup in shorting activity. The 10-day put-to-call ratio is around 7. We thought that was very bullish. Anytime you have that pessimism, strong price action, technical backdrop, that's good for a bullish trade. And that's so we entered this December 80.79. Now let's take a look at the dynamics of how this trade was created. It was a bullish credit spread. IWM was trading at 82.30. Remember, we sold the 80, so it was about $2.30 below the current stock price. So it gives you a little bit of wiggle room for you to still profit from a slight move against you. So we sold the December 80 put for 36 cents and purchased the December 79 put for 24 cents. Just to sort of show you exactly how these return on margins and money's brought in, collected 36 cents, purchased 24 cents. Difference between those, 12 cents, 100 shares per contract, $12 per contract. Now, what's your risk? I talked about your risk being defined. The risk is going to be the difference between your strikes, 80 minus 79, minus your premium collected, because no matter what happens, you keep that premium collected. So the difference of that is going to be 88 cents, again, multiplied times 100, so $88 per contract. Return on margin, simply your reward versus your risk, is going to be the 13.64%. Just real quick, I want to talk about 13.64%. May not seem like a huge gain, but this is going to be, remember, that higher win rate strategy, higher batting average, compounding those gains. And again, a lot of these are only going to be 4 to 6 weeks out, or whatever time frame perhaps you like to work in. So on a shorter term basis, those small gains can really add up when you have that high win percentage. So let's look at the result of the trade. As you can see, we entered right there at that pullback at around the 82 area, and we got a nice bounce in our favor, and then actually declined back just as sharply as the bounce occurred. The directional trader, perhaps if they bought an at-the-money option, might be looking at a loss because that time decay over that couple-week period had passed. The credit spread trader could remain patient, not as worried about the consolidation or slight pullback as the directional trader could be. In this case, we saw the premium collected, the maximum gain of that 13.64% was achieved. Now, shifting gears just a bit, the iron condors. Now, what is an iron condor? It's kind of a funny name. I always say if you understand credit spreads, iron condors are very simple and very easy. It's basically just a bullish and bearish credit spread combined together. So simultaneous sale of a bullish put spread and a bearish call spread, same month, different strike prices. Basically, your ETF or your stock, whatever security you're making that bet on, is going to be situated between the bearish call spread and the bullish put credit spread. And just remember, 2 credit spreads means 4 options. And your goal was for that ETF or that stock to finish above the put strike and below the call strike. So you're sort of betting on that trading range to occur. So when do we want to do these iron condors? When we expect the underlying to remain within a specific range during a defined time period. So that makes sense intuitively. If you're betting on that trading range, I think it's going to stay below this level. I think it's going to stay above this level. As long as it does that, you capture and keep your maximum profit and all that premium you collected. If we expect lower volatility, perhaps post-event, a lot of times those premiums are taken out at a very fast rate. We can capture that volatility and profit from that rather than losing that if we're in a long premium position. And when you want to profit from time decay, sometimes those premiums are very expensive. Premium selling strategies like the iron condor and credit spread both make sense in these situations. And you just don't expect that big directional move. Remember, you're betting on that trading range. You're betting on that call strike, the stock to stay below the call strike and above the put strike. So a big directional move is not what you want. So when we expect that trading range behavior, these are going to be great strategies. All right, now let's just look at a generic example of the iron condor. It's sometimes easy to see visually than me spending all day talking about these verbally using words. You have an entry point here. You expect from this point right here, this security to stay below 88 and above 74. You don't care if it rallies here, rallies down here. It doesn't matter. As long as it stays below those strikes, you achieve your maximum gain. So here until expiration. So even though you had the sharp pullback, you remain patient. Time decay was working in your favor, and you're able to achieve max profit. So you can kind of see intuitively here, call spread up top, put spread down below, sandwich right in between is your security. As long as it stays in between those, you're going to achieve those maximum profits. Now let's take a look at a real iron condor trade just to kind of give you an idea of some of the stuff we may look at when we're looking to enter those. Now this was one that was recommended I did on July 23rd of 2012. The expiration date was August 18th, so it was an August option we used. Now, as you can see, we sold the August 84 call, and we purchased the August 85 call. And down below, we sold the August 71 put, and we purchased the August 70 strike put. So in this scenario, we actually collected 12 cents for both spreads when you combine them, and it was about a 14% return on margin. So the stock, the IWM, was trading around 76 or 77 and change. And as long as the IWM didn't rally above 84 or fall below 71, so we had that huge cushion in both directions, we earned about 14% return on our margin over that several week period. Just a couple things I was looking at here. The IWM broke below significant support at the 79 area that you can see had been previous support and resistance, so a technically important level. And just some other areas or things we're looking at. That sold put strike is actually below the previous June low. Now, previous lows, which also, let me mention, was coincided with the 50% retracement of the rally off the October 11 bottom. So that June low 73 area was a very important level. Technically, sold a couple points below that just to give it some wiggle room in case that pullback occurred. And on the upside, let me just mention the sold call strike was actually near the previous 2012 peak. You can see oftentimes previous peaks and resistance areas can act as resistance again. So there are some technical factors we look at to position these, as well as when we just look at volatility or premiums. Now, I touched on volatility or premiums about looking for that high premium environment where perhaps directional trading doesn't make sense just because it's so expensive. This is a chart of the volatility index. It's actually the RVX, very similar to the VIX index on the S&P if you're familiar with that. Basically just a gauge of how expensive options are. Now, it tends to be somewhat mean reverting. I have these envelopes here where it's basically just showing times in which premiums are perhaps pretty expensive. You can see under this red circle here, this is when we entered that Condor. So not only technically did it make sense, but from a volatility perspective, we actually had premiums at a very high level. It kind of made sense to capture some of that premium and use a premium selling strategy like the Iron Condor at this time. Let's take a look at the result here. It broke below that support area, consolidated for about a week or so. As a Condor trader, remember, consolidation is our friend. We're not, time decay is our friend, so we don't need big directional moves. Now you can see after it consolidated for a bit here and went sideways, we actually got a trend. Now it went up to about 82 or so, which was still a couple points below that sold call strike. And as it doesn't matter how close or how far away, as long as it finishes between or below that call strike and above that put strike, we still capture that maximum profit. This was about 1.5 weeks into the trade. The IWM was actually trading more than $1 below where it was put on. The whipsaw price action, again, benefits the trader who bets on decreased volatility and sideways price action versus the trader that's betting on the direction or buying that time premium. Now at Schaeffer's, we've been trading the iron condors and credit spreads for a service called the Wealth Builder for almost 20 years now. So as a company, we've been doing it for a long time. You can see some of the results here. We've had 945% return over that 20 years versus S&P of about 238%. And I also just want to draw your attention to the 79% win rate. I talked about that. Win rate can be very important for compounding gains over the long term, and probably why we see these nice returns here as well when you have that high win rate. Over that experience, over that time, there's a few tips, some things the company and something personally I've learned just from these. Expensive options don't always have to be a hurdle. They can be an opportunity. So just remember that. If you have tools like the Iron Condor or credit spreads, they can be opportunities, not hurdles or obstacles for you as a trader. And remember, volatility, but don't forget price. A lot of people will focus only on volatility, and I've seen it time and time again. They'll be right on volatility where premiums are high and they want to sell premium, but perhaps they sold that bearish call spread. Premiums declined and that stock or ETF rallied above the call strike. So they were right on volatility but forgot about price and were wrong. You still lost money. So one final thing, focus on liquid securities. Don't sell at the bid. Sounds kind of cliche, but oftentimes the more liquid, the more narrow the spread. That's going to be your best scenario risk reward when you're entering those trades. If you have that wide spread, don't sell at the bid. Simply put in some orders, try to get it above the bid. You'll usually capture a little bit more premium. And when you're talking about these trades, every little cent can count and really capture that premium and really maximize your returns over the long term. With that said, I want to thank everyone for taking the time to listen today. If you are new to options or these strategies, hopefully you're able to learn a few new things. And if you actually have a little bit of experience trading already, hopefully there were 1 or 2 nuggets of information that you can take away that can help you with your trading today. And once again, I just want to thank everyone for listening and wish you all the luck in the world on your trading.